Well, today is certainly a very busy day on the earnings calendar. You've got a whole host of large caps like Hero Moto, SBI, as well as NTPC that will be coming out with their numbers. But among the lot, we'll also be watching out for Zee Entertainment to deliver their quarterly show. And do remember, it has been quite a disappointment so far in terms of their earnings, although we are seeing ad revenue growth picking up. There's been rejig in management, the strategy has changed, and the general environment for the company in terms of ad growth has been a little bit muted. The stock price in going into the numbers absolutely flat at about 244, so up very minorly, about 1/3%. But I think the street will closely be eyeing what Zee Entertainment actually delivers in the Q3 earnings. So here's what the ET Now poll is penciling in on a consolidated basis for Q3 FY21. We're working with a profit at about 354 crore rupees versus 349. So that's just about flat, an increase of 1.4% on a year-on-year basis. Now the top line growth or the revenues are seen at about 2,073 crores. This is versus 2,048 crores. So yet again, on a year-on-year basis, you're not expecting any fireworks. It's just about flattish, up about 1.2% on a year-on-year basis. In terms of the operational performance as well, we're looking at EBITDA at 518 crore rupees versus about 565 crores on a year-on-year basis. That's down about 8% on a year-on-year basis. And we're expecting the margins to come in a little bit contracted this quarter at 24.9% versus 27.5% year-on-year. Now do remember that you have seen the original programming hours gradually reverting to the pre-COVID levels. So that is likely to aid strong growth when it comes to the ad volumes as well as the ad rates in Q3. And that continues to remain a very strong determinant for what Zee Entertainment delivers in the quarter. Not just that, the company is also likely to benefit from the conversion of the pay channels to FTA, and that's likely to drive the ad revenue growth. So we're not working with very high expectations, but about 5 to 6% ad revenue growth. New show productions as well are expected to attract advertisers, so that's going to be a bit of a positive for the company. So by and large, we're expecting fairly healthy viewership, and this is coming in across their channels. Do remember their regional channel growth has been fairly steady every quarter. Margins, as I said, could decline, so we're penciling in 24.9%, and that's on account of the adverse operating leverage. Though on a sequential basis, we could see margins improve. The like-to-like subscription revenue could increase by 10% YOY, and that's largely on account of the digital business. And EBITDA, although it's likely to be down year-on-year on account of investments in digital and the operating deleverage due to the muted revenue growth, as I said, on a sequential basis, it could be higher.